And we're going to kind of dive into what that is. And really the reality of it is we don't know a lot about it right now. We have just few nuts and bolts to work with.
But that ad did a masterful job of pulling at the heartstrings of parents, because every parent wants their kids to be financially successful, and more so than themselves, if at least in my experience. We want our kids to do even better than us. And so it did give you kind of an idea of what these are intended to do. But just like every other thing that comes out from our legislators or our government, there's a lot of pieces we don't have defined yet. But we can go through the ones we do know. So they are tax-advantaged investment accounts. What that means is that as it grows, it's not being taxed each year, just like an IRA does. It grows, and until you're pulling money out, it's not taxable. So it is tax-advantaged. It does let families invest on behalf of the child. So it's not just the parent that can put in it. The family can too. The one thing that felt a little vague to me about is, where's it going to sit? And the investments, it said U.S. stock market index funds intended to grow over many years. Well, that's great. Yep. But what is it?
Yep. So flexibility may be an issue there if you're restricting investments. So the biggest plus that I see is you're going to get free money out of it, right? There is a one-time $1,000 government seed contribution that would be made available for U.S. kids born between January 1st of 2025 and December 31st of 2028. So it's for the newest generation of Americans right now. Now, there is talk about backing that up to people who were born prior to January 1st of 2025 and are still under 18. But for now, they're looking at the only thing you have to have is a Social Security number and citizenship, and you get a $1,000 seed into an investment account for your child, and then you can add to it. Parents can add to it. It says even employers and charitable groups can contribute to a total of $5,000 per year before the child turns 18. Now, the Super Bowl ad, again, tugged at the heartstrings, but it also kind of maybe embellished a little bit on the nature of how this account could grow. I'm all for this in principle. We'll have to see as it rolls out what the particulars of it are, but it did kind of maybe overstate how much this money could grow.
And I feel like a lot of times when there are investments being illustrated online, they say, well, if you do this, then you'll have this after this period of time. But they don't go into the details and the nuance of that. So, they were saying, oh, your kid could be a millionaire. Well, by when? And what funds were being added? Because I can tell you, if you do the math on just $1,000 sitting in a U.S. large cap growth fund or ETF, and that's all that got invested, that's not growing to $1 million during that child's lifetime. It's more like 5,000 or something like that, which is still great. But if you really want your child to be successful, you're going to have to add more to it. And I think you had done the math on this to kind of give people a picture. So let's talk through that.
Let's do realistic math here. So again, at 18, so let's assume you started with $1,000 at birth and you added $400 a month. So that would be $4,800 a year, which would almost get you to the $5,000 cap. At a rate of return of 8%, which is the historical long-term average of the U.S. stock market, over that child's birth to 18-year span, you'd have nearly $200,000. I think it came up to $191,000. So certainly worth doing, and that's fantastic.
That's still a huge leap towards a down payment for a home. They could almost buy a home with that. Of course, who knows?
Maybe
in
not
18 years.
and depending on where they live. But that is a reason. That is an option that they can take it out and not have to pay taxes on it, is to buy a home. Open a business is in there as a reason, and education is the other. Now, there are already accounts that exist that have these tax advantage features like a 529. There's also an UTMA account that you can set up for a child who's under 18. We don't really care for those too much because you do have to hand the keys over to all of the money when they're the age of majority, which in Arkansas is 21. So they're problematic. I've dealt with those on the back end after clients already had set them up.
I had a client call me the week after and said, hey, my son's not making the best choices. I really don't want him to be able to access this. And I had to say, I'm sorry, it's his. At 21, it's his. But I wonder if this one is similar, but at 18. So again, that's one of those pieces we really don't know the details of. So you want to be very intentional about how you use these tools. And, with the 529 plan, now there's the option of taking a portion of that at least and putting that into a Roth. So, figuring out which one of these makes the most sense for you really needs to be a conversation you have with your financial advisor.
Yep. It's certainly gained interest. Nearly more than 1 million signups have already taken advantage of this, saying, I want to be a part of this. We think it's a great thing as a savings tool, but we would just need to know a little bit more about how it works before we would advise a client to get into it as opposed to another route.
And I would say before we move on, the way to win if you're going to do this account is to teach your kid about it throughout their lifetime. Let them be involved in that process of it growing, understanding how investments work, so that when those keys are handed over, they're ready to handle them.
So we're talking about saving early in that topic. Now we're going to talk about how people are not saving at all. Take a look at this Market Watch article. It's a sign that it's not going well. Or it says that it's going well.
It's not a sign.
It's not a sign. There we go. I said it wrong. It's not a sign that it's going well. The median amount American workers have saved for retirement is $955. That is a shocking number. We've done many, many stories over the years on this show about how Americans are behind on their retirement savings. This is more than behind. This is next to nothing. However, I do think you need to get under the hood a little bit of it. It is certainly not good, but the median means that this includes everybody across all ages, across all spectrums. So it does include people who don't have any money saved for retirement. And unfortunately, we know that's a lot of people, and that brings the median down sharply. But it also includes people who are just getting started, right, in their 20s and have had not much time to build up retirement savings. But having said that, if you take out the workers that don't have any retirement accounts, it jumps to $40,000 or more as the median number, still woefully low.
Yeah, still incredibly low and not going to meet your needs if you're working towards retirement. I think one of the other things to think about here is, when I think about this, is what's causing this? What is causing people not to contribute, or maybe not to contribute as much? I know when I started working here and working with clients, one of the things that a lot of people believe is, well, if I'm getting the match, I'm doing what I need to do. But that may not be what you need to do. You may need to do more. And in some cases, there's people who are putting in way too much. So not having a clear picture of what you're aiming for can really create chaos here. But I think education is a big problem here. People understanding their plan, understanding the benefits and what it means for them long term.
Yeah, there are a lot of people that don't have access to employer-sponsored plans, and so you talk about the people who do participate and think getting the match is enough. A lot of people may think, if I don't have that 401k through my job, and there are still a lot of people that don't, that they have no way to save.
I'll tell you, that was me.
Yeah.
Before I joined the GenWealth team, I had been a bookkeeper for a long time, and I did not realize that IRAs were even a thing. I had savings. I was making good financial decisions otherwise, but I just assumed we would have to wait till my husband, because I was staying home mostly, and then doing the bookkeeping on the side. I assumed that until he had access to a plan when he finished college, we were just going to have to delay. I did not realize what was available. And now I know if you're 16, you can have an IRA. Mm-hmm. That's amazing to know, but most people, I don't think, know those tools exist.
Yep. You have earned income, you have access, and are eligible to contribute to a traditional IRA. And if you don't have a substantial amount of income, if you're not a terribly high earner, you actually have access to contribute to what's called a Roth IRA. And I would certainly suggest anybody taking advantage of that, especially if there is no employer plan in the picture, because those dollars, as we talked about with the Trump account, those dollars grow tax deferred and will be withdrawn tax free in retirement. So a great opportunity to kickstart your retirement with a Roth IRA.
I think another gap there is people who have small businesses. I don't know if you know this, but if you have a small business, you have access to small business employer plans. And depending on your size and your income, there's different factors to consider. But you don't have to be eligible for a 401k to be able to have an employer plan. There are other options available to you as well.
Yeah, I'll wrap this up by saying, too, this thought made me think of one case that we have, or one gentleman that we're working with. It can be easy to think, as you get on later in life, if you're somebody that thinks, man, I've just been beaten up, I have never saved enough for retirement, it's too late for me. We're actually working with a guy who is in his early 50s. He's about my age. He's got about $100,000 saved, so a little bit above this median average, but that's not a lot. It's not going to be enough if he doesn't do something. But we've done a plan for him that shows with some changes to his contribution rate, and they're not like astronomical. It's going to hurt. He's going to have to find a way to get that margin to be able to make that contribution rate. But if he does that with a a good rate of return, similar to what we talked about on the last piece, he could still be a millionaire at age 70. Right now, he's going to have to work till he's 70. There are going to be some hard decisions along the way if you are not prepared for retirement. But it is an example of, if you're woefully behind and you're in your 50s, you may have to work longer. You may have to get that contribution rate up significantly, but you can still do it. There is still time.
Yes, and you become allergic to debt. If you can't save more, get allergic to debt, bring down your income need, those two working together can really make a difference for you if you feel like you're behind. I mean, your 50s are your highest earning years typically, and usually kind of, if you're unlike me, I had kids late, so this isn't for me, but for most of you, you're going to have most of the kids off your budget somewhere in your 50s, and so you have some wiggle room typically to catch up. But if you don't feel like you're going to have that wiggle room, get allergic to debt, bring down your income need.
Yeah, I'm not quite there. I've got a couple of years left, get those kids out of the house, but unfortunately now I have a grandchild.
Yeah,
so
it changes things totally.
Won't cost as much on a day-to-day basis, but I got a feeling that there's going to be some money spent there. Our last headline, corporations now own nearly 9% of residential land in the U.S. and could own 40% of rental homes by 2030. This has been getting a lot of buzz. We've heard a lot of clients talk about this, especially because we do use some real estate type investments in some of our investment strategies. So that's a question we get a lot is, hey, do they own residential properties? The answer is yes, some of them do. They don't have a substantial amount in their portfolio, but this is a very big topic of discussion. You know, President Trump issued an executive order in January aimed at preventing or restricting corporations from scooping up all of the residential homes. And I think this is a thing that it should be addressed at least on the local level. You know, I think the government can play a role here because this is not good for home ownership in the United States. I'm all for capitalism. I'm all for corporations making money and us being able to invest in those corporations in the form of stock and creating wealth. And I want that to continue, but I also want people to have the American dream.
Yes, and I think one of the challenges when you have these companies buying up these homes is that they're buying the more modest sized homes, which means young investors, young purchasers are having a harder time finding a reasonable price house to buy. So, you know, there are some statistics that say younger people aren't really looking to buy homes also. So that may be part of why there's this open door for these corporations. But one of the challenges is that they're typically going to raise rent every single year, whereas your private owners are typically going to give you a little more wiggle room in that going forward. The other thing I noticed when I was reading this is that the rate of complaints is a little bit higher when you're looking at corporations, but I'll tell you, I've had individual landlords and I've had corporate landlords. I had good ones and bad ones on both sides. So I don't know that that's necessarily the deciding factor, if that's just kind of something we've noticed. Yeah.
On one hand, this is an extension of the apartment building industry, right? I mean, certainly that's oftentimes owned by corporations. And so we're already renting from corporations. But I think the problem with home ownership is a big deal right now. If young people are not doing it, we've done stories before that the average age of a first-time home buyer in the United States now is 40. Which is incredible to me. Some of that is by choice, right? There's proof out there that they are choosing to invest first, then buy a home second, which is opposite of the way our generation went about things.
And very healthy to do.
Yeah, no question about it.
Very healthy to get a foundation first.
But I do think I want the home inventory needs to be protected in some way. You know, I think about, I have my wife and I have a home in Fayetteville that we rent out as an Airbnb. When we went through the process of getting a short-term rental license in Fayetteville, they had capped it. They have capped how many they're going to do because they're trying to protect the inventory available for homes for people to purchase. And I respect that. I respect that. I don't want that to be suppressed and to be too much government involvement, but I do think local governments where this is happening, because it's not happening everywhere to the same rate. I think the article talks about St. Louis, Baltimore, and Miami. They in those places, the corporations own a far larger share of the residential parcels. Those local governments can act and put a restriction on that, and I'm all for that.
And I would imagine that's the best place to have that done because they know their communities, they know the people that are shopping for homes, so they have the understanding of how to limit it without kind of throttling the growth of their community.
Yeah, and you talk about promoting financial independence, which is what we do. Home ownership is certainly a big piece to that, especially when it's paid off. When that mortgage is paid off, you have great financial freedom. Hey, that's going to do it for our What's Happening segment. Time now for the Get Ready for the Future show.
You've been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Coming to you from the 6th floor of 3 Financial Center in West Little Rock, Arkansas. This is the Get Ready for the Future show. My name is Scott Inman, a financial advisor here in our Little Rock office, and along with me, co-hosting today, Teresa Arago from our Conway office. We have many offices across the state of Arkansas at GenWealth Financial Advisors. That's just 2 of them. We also have one in Hot Springs, El Dorado, Bryant, and northern Louisiana in the Shreveport-Bossier City area. So if you have a question for us, you can go into the office and ask an advisor there, or call one up, or you can send it in to us, which is what the people that we're going to share with you today did. The number to do that is 501-381-5228. Again, it's 501-381-5228. You can text your question, or you can leave a voicemail by calling that number, and we'll use that voicemail on the air. You ready to go?
I am.
All right, first up today is Roger from Fort Smith. We just retired last year and are spending more than we expected. How do we rein in our budget before it becomes a problem? Roger, thanks very much. And I'm going to tell you, you're in not unique company, but I would say it's far more often that we work with people who are scared to spend when they come in to see us for the first time, and they need a plan to have the freedom to spend. But I'm going to also suggest that plan will open up spending for some people. It can also put guardrails down for somebody like you, Roger. So I think that's the question we would ask first is, do you have a structured retirement income plan that you are following? Because if you don't, your spending could get out of control real quick.
Yeah, I think it's no different in this aspect to your working years. If you don't have a budget or some guardrails to work with, not that I'm saying you have to manage every single dollar, but if you don't have some guardrails, it's really easy for additional spending to sneak in, and then you get this feeling of, oh, we're out of control.
Yep.
So that is not uncommon. You know, we tend to see our retirees, really the retirement process kind of broken down into 3 kind of phases. You've got your go-go years where you're out, you're sometimes more expensive in those years because you're doing more things. And then you have your slow-go years where things start to slow down. You're not traveling as much. And then, of course, as you get into your later years of retirement, you're not traveling hardly as much, but of course your medical expenses tend to be a little more. Right. So that is normal for those first years to be a little more costly than some of the later years when it comes to your additional spending. But in general, like Scott said, you need to have a strategy that creates the guardrails so you know what's sustainable long term.
Yeah, and I would say the first step here is when you talk about the way we spend and the time periods that we spend, we don't know where you are right now, but you need to identify what is causing the leak, right? Not just the total amount you're spending, but where are you overspending? And it may be multiple places, but instead of just saying, hey, we're spending too much, break it down into categories. Are you pulling out lump sums from your retirement account to take big-time vacations and entertainment, and that's kind of got you thinking you're spending too much? Are you doing home improvements? Are you dining out too much? I'm guilty of that, by the way. If I was to look back, well, and I do.
Most of us.
Look back at my monthly expenses and how much I spent on restaurants. My goodness, I don't even want to talk about that. But
moving on.
Yeah, subscriptions and recurring expenses. What is it? Basically, identify where is your overspending, and that can help rein it back in. But I also think when I think about that, separating desired spending from required spending is a part of that process too. If you watch our show at all, you know that we layer in a monthly income plan with required income and desired income, and separating those can be helpful when you're trying to identify where you're spending too much.
Yes, and that's so critical for our ready to retire process when it comes to planning for your income needs, is separating those two out. Just like your current budget, if you're working, you have a certain number of things that have to be done, your utilities, your mortgage payment if you have one, cell phone bills, things like that. But there are other things that if you needed to trim the fat a little bit when it comes to spending, you could, and it wouldn't take away from the joy in your life. if you delineate those separately and you plan those differently, it can really positively impact your long-term success in retirement.
Yeah. So you also need to take a look at this is it's a good thing to do if you don't have a plan, but then don't let it be the only thing you do, but revisit your withdrawal rate. If you take a look at your overall portfolio, and I'm assuming if Roger thinks that they're spending too much, then they're pulling some of this from their retirement savings. Take a look at what percentage of your portfolio you're pulling out on an annual basis. You've heard of the 4% rule. That's a good place to start to go, is this too much? But it's not the only thing to lean on, but 4%. So if you have $1 million, if you're pulling out more than $40,000 a year, and that's gross before you have any taxes withheld from that, that may be a warning sign that you may be pulling too much out of your portfolio. Now, once you've thought about that, because I may have said that, and sometimes I try to put myself on the other side of what I'm saying, and people may go, oh, I'm taking out too much money. Yeah. Maybe not. That's the first step to identifying it. But then you need to sit down with a financial advisor that does retirement income planning. We do that here at GenWealth all the time. And we create a monthly income based on your required and desired income. And that will help you more systematically take that money out of your portfolio. Because I don't know if Roger's taking this out once a year, just kind of ad hoc whenever he's thinking about it or whenever something comes up. But if you don't get your spending into some kind of guardrails based on a plan, it definitely could drain your portfolio. And to your point earlier, you may think, and we have clients like this, I don't really need as much income later in life because I'm not going to be doing those things. I'm in my no-go years, but you still have to have a substantial amount of income ready for yourself and your spouse because you may need it for reasons you don't really get excited about.
Yes, and when one spouse is here alone, those assets need to sustain them, and they're going to lose one of those Social Security checks, whichever was the lower. So there's more than just we need this income to last. Again, if you can tell me exactly when you're going to pass away, I might be able to refine this down. But also, I did this exercise with a client recently where we tried to front load their retirement and show them, okay, here is the maximum you can take now, even if we lower it down later. And it was not worth it because it was going to deplete so much of their assets early on. But what you really need to watch out for is one-time costs that are masquerading as budget, right? Yep. There are times early in your retirement where maybe you planned that once-in-a-lifetime trip or a couple of once-in-a-lifetime trips, and now you're thinking, oh my goodness, we're overspending and this is the habit. Well, no, it may just be that this was an expensive year and it's going to be fine next year. But you do need to have that conversation with your advisor.
Yeah, Roger, I would suggest if you don't have an advisor, pick up the phone and call us and walk through the GenWealth Ready to Retire process. And that also goes for anybody with a similar question. How do we know how much we can spend in retirement without running out of money before we run out of time? Well, the answers lie in the GenWealth Ready to Retire process. And building a retirement income plan is easy to get started. You can call us, 866-653-PLAN. That's 866-653-7526. And that'll get your first appointment scheduled with a GenWealth advisor near you. And that first appointment costs you nothing. All we're going to do is ask you to bring a few documents in so we can get a better idea of where you stand, talk to you about your goals and retirement. And we will tell you how we build our plan and our process. And if you want to move forward, then we talk about how we're compensated. So there's really no financial downside to building that or to scheduling that first appointment with a GenWealth advisor. And if you want more free info about retirement, investments, and your money, we'll invite you to subscribe to our YouTube channel. You may be watching the Get Ready for the Future show on our YouTube channel. But if you haven't subscribed, you may be missing out on some other free resources. So go to YouTube and search for GenWealth Financial Advisors and subscribe to our channel for some free content about retirement, investments, and your money. Next question is from Sierra via text message. I plan to retire at 65, but may still work part-time. How do I plan income and taxes if I'm only partially retired? Great question, Sierra, and this is very common for many people at GenWealth and part of the retirement income planning process where we can layer in some part-time income, which can really help delay taking larger withdrawals from your portfolio and push that down the road, especially when it's doing something that you want to do rather than something you have to do. So we call it work-tirement around here. I think John Shrewsbury coined that phrase.
We're at least going to give him credit.
Either that or he stole it from somebody is what I was going to say, so you're much kinder than me. But it can create, or does create, multiple income layers. I think the first red flag that pops out to me, or first bell that rings for me, is if you are doing this and you're 65, that means you're not yet full retirement age when it comes to your Social Security benefit. If you're born 1960 or later, which really we're dealing with everybody that is not currently on Social Security anymore, 1960 or later, your full retirement age is 67. Why does that matter? If you are still planning to retire, there is something called an earnings limit that Social Security implements. In other words, you can only make a certain amount of income in a given calendar year while taking Social Security prior to your full retirement age. And if you go over that limit, Social Security will ding you for it. In fact, they will reduce your benefit by $1 for every $2 that you make over the limit. In 2026, it's $24,480. That's the annual earnings limit. So you got to watch out for that if you're going to work part-time and take your Social Security benefit.
Yes, and I want to make sure that we don't treat this like a deterrent. There are a lot of people that they cannot stay where they're currently at for any reason, whether it's an emotional need or a family need. And so they're not quite where they want to be to where they're going to go to the house and stay, but they might want the routine. They might want a little extra income. So a work-tirement can be very fulfilling. I've seen it really work fantastically for several of my clients. But if you walk into it uneducated about specifically the Social Security issue, then you may end up owing money back to the government when you go to file your taxes. So you want to be very cautious to go into it educated. And, you know, there's ramifications for your Medicare benefits. Yeah. And the cost of those benefits is dictated by your income. So there may be some impact there as well. You want to make sure you actually apply for Medicare even though you're not fully retired. So there's some things to think about there. The other is taxes and managing and mitigating your taxes. You know, I'm not someone who's going to tell you you're ever going to be able to avoid taxes fully. I'm not going to lie to you about that. But your earnings from Social Security are taxed differently. Your earnings from your investments are taxed differently than your wages were. So understanding the impact of that and making sure you're having enough withheld is also equally important for you as you walk into that.
I love that you say that because it is true. There are people out there that would tell you can avoid taxes in retirement by doing XYZ special investment things, and that's
which
just
usually
not true.
Means a huge ding up front to taxes.
That's what
so you can avoid less taxes later.
I'm very often I've said that you can have a tax-free retirement, but you have to analyze how much it's going to cost you in taxes to have that tax-free retirement. Right?
That's so true.
Yes. So you can get there, but you have to do it more pragmatically. We do tax planning at GenWealth, and certainly it does also, work-tirement, provide a good window for possibly doing some strategic Roth conversions. So when you talk about the taxation thing, this is a big conversation we're having with a lot of clients right now. Roth conversions. Does it make sense? And it's not a blanket yes or no answer for sure, because they're appealing. I think for me, I would always err on the side of I would love to get as much money into Roth accounts as I can, because it creates so much flexibility for you in retirement, because you can take that money out tax-free, so it's never going to make you jump into a higher tax bracket. You also leave tax-free money to your kids rather than money they're going to have to take out in 10 years, which can be a big tax bomb with the inherited IRA rules. So looking into it always makes sense, but you have to be prepared for what it's going to cost you in taxes to do it.
Yes. And then when you think about health insurance, you know, often this is a bigger issue if you're below age 65. At age 65, Medicare does become your primary coverage, and the Part A does, and then Part B, it depends on your circumstances with your employer. But if you are trying to do a work-tirement, are you going to be eligible through benefits at the employer, or are you going to rely on Medicare and supplements? You need to think that through and the cost of each before you step into it, so you understand, I mean, are you going to end up working just to pay premiums? You know, so
Absolutely.
You need to figure out if it makes sense for you. And then you also still need to align your spending with your plan. So even though you're working part-time, that doesn't mean that the keys are open to the kingdom when it comes to spending. You still have to stick with your plan. You need to still understand, what is my required income, and do I have that covered? What is my desired income, and am I going to have that covered? Because you can get into this mindset of, oh, I've still got a paycheck coming, it'll be fine, I can make it up later, and build some very unhealthy habits with your money in that time if you're not careful.
Yeah, GenWealth, we see work-retirement as a purposeful transition phase, not a permanent fallback. So when it's done right, it can supplement income, ease portfolio withdrawals, as we've already talked about, improve tax efficiency, delay or optimize when you start Social Security, and give you structure and fulfillment after full-time work. But coordination is key. Income from wages, Social Security, and investments must be integrated into one income and tax plan, not treated as separate silos.
You know, I see that a lot with retirement planning in general. I think a lot of people have this mentality that everything is a separate issue to be dealt with. I've got my estate plan, that's a separate issue. I've got my insurance, that's a separate issue. I've got my investments, that's a separate issue. The reality is, all of these feed into your financial independence. And if you're not using a process like our Ready to Retire process that covers all of these and more to make sure everything coordinates well, you might end up getting blindsided by something later in retirement. So even if you're not working on a work-retirement, all of this stuff has to be coordinated. And if you don't have someone use the football terms, since we just had the Super Bowl, quarterbacking for you, then you may find that it's not as successful as it could have been.
Yeah. If you'd like to go through the GenWealth Ready to Retire process, as we mentioned earlier, it's easy to get started. 866-653-PLAN. 866-653-7526. Right now, you'll get in touch with a GenWealth team member who can set that first appointment. You can also send us an email, info@getreadyforthefuture.com. And for Sierra, she's been named the question of the week, and we're going to send her a free Get Ready for the Future show tumbler like the one I've got right here on her desk. But we just need an email from you, Sierra. Send it to show@getreadyforthefuture.com to claim your free tumbler. Next up, James from Lone Oak. My wife doesn't work, but I do. Can I contribute to a Roth IRA on her behalf? Yes. Moving on.
I was so excited to see this question because I do get asked this a lot in the room when we have one spouse who's staying home and they're like, well, what can we do? We only have this one plan at work. No, you actually have options. So let's stick around for just a few moments on this one.
And the caveat is, I said yes, you do have some income limits there to be eligible to contribute to a Roth IRA. It's for a couple, it's about $250,000 a year. So it starts to phase out at that point. So if you're under that, let's assume you're eligible from an income perspective, your wife does not have to work if you do, because you're likely filing a joint return. So from the IRS's perspective, your income is both you and your spouse. So that makes her eligible for a spousal IRA or Roth IRA, which can be a powerful planning tool. And many families overlook it, just like Teresa was talking about. So what you can do is you could actually have one for both of you. Okay. So the 2026 contribution limits are $7,500 for each person under age 50 and $8,600 for each person age 50 and older. That's the catch-up amount. It's a new catch-up amount. Usually it's only been $1,000. They've added an inflation adjustment there after decades of not, so I'm not sure how all that works.
That one threw me off when I started talking to clients because I'm used to it being $1,000 difference. And then actually it was Georgia, who is one of our newer advisors. She goes, no, it's $8,600. And I looked at it and go, yep, it is.
Little bonus of $100. So $8,600 for each of you if you're 50 and older. We don't know how old you are, James, but for anybody listening, if you're a one-income household and you're filing that joint return, $8,600 each if you're 50 or older. And for 15, 20 years, that could make some really significant headway.
It really could. And even if you don't qualify directly to put into the Roth, there are options. We call it a backdoor Roth that your spouse may be eligible for as well. So there's still ways to put money into that Roth option. So the key there is just to make sure that you have the cash available. Of course, you've got to have some margin in your budget to be able to do this. Unlike your employer plan where it gets to be withheld before you ever see your paycheck, when we're dealing with IRAs, that's coming out of your bank account. So you want to make sure that you have got the margin in your budget to support that IRA, but you have a lot of wiggle room here.
Yeah, we've talked about Roth conversions in the prior question and talked about Roth IRAs in this question. So it may be a good moment for people who are not clear on how that works. What is a Roth IRA? The reason it is such a valuable tool is it builds tax-free retirement income. Now, you may know that, but when you think about how that actually applies when you start living your retirement and you're taking Social Security, which is at least partially taxed, mostly taxed by the federal government. In Arkansas, it's not, but you're going to have some taxation due on Social Security. If you have a pension, there's going to be some taxation due there. If you are taking withdrawals from your other accounts, like a pre-tax IRA or 401k, you're going to owe ordinary income tax on that. If you have a taxable non-retirement account, you're going to have capital gains due on that if you take withdrawals. The Roth IRA is the only thing that you have a tax-free option for. So when you think about, Teresa, they walk up to the top of a tax bracket and maybe about to go over it. If they have Roth dollars, it can bring them back down because it doesn't count. And then the reason I like it the most is it's a lump sum place to go. If you need a new car, if you want to take a once-in-a-lifetime trip, you don't have to worry about taking too much out and jumping a tax bracket.
And, taxes are different in retirement. You're not paying Social Security tax in retirement, so it's a little bit lower than what you would have paid during your working years. However, it still can be impactful. When you take distributions from pre-tax accounts, that increases your income, and your income determines your Medicare premium. So if you did have one of those large lump sum needs, that Roth can be a fantastic tool for taking those without it impacting everything else you're dealing with that year. So it's certainly a great tool to have. I will say for a Roth to be useful, it needs time. So I had someone come in just the other day. They are in retirement and they were asking, do we need to be doing Roth conversions? This year's not going to make sense for them. But we talked about that dynamic of what's your goal. They don't have a huge amount that's in pre-tax money. A lot of theirs already is in non-qualified or non-IRAs altogether. And so in their case, these funds would not have enough time to grow to make it make sense for them to take the tax hit now. So this isn't just a decision you can make in a knothole, but if you're thinking about adding to a Roth account and you don't need any tax benefits off of the traditional, or you don't qualify for those, it is absolutely a fantastic tool for later on.
All right, we've just got a few more minutes on the show, so let's get to our last question. Arthur from Little Rock asks us, we're 60 and still have 10 years left on our mortgage. Should we pay it off early or just keep making the payments into retirement? Great question, one we get very often on the show and in our meeting rooms, quite frankly, Arthur. I would say let's start off by the jumping point of this. We believe if it's possible, you should enter retirement without a mortgage. But that doesn't always mean you will, right? So this may change over the years, especially as our younger advisors work with people who are buying houses now at higher mortgage rates. But for the most part, we're working with people. If you're 60 and you got a mortgage, Arthur, you've likely had it for a while. I would assume you would have a pretty low interest rate, right? It could be south of 4%, could even be south of 3%, right?
Yeah.
So if you got those low interest rates, you're not getting killed on it, especially if you're thinking about taking money out of investments to pay that mortgage off and what you're going to lose on the upside. Now, having said that, you also have to think about taxes here.
Yes. So if you're going to, in retirement, you have very few tax breaks typically in retirement. The mortgage interest is usually one of those that you can take. The other side of it is if you're having to take out of a pre-tax account a lump sum, well, we talked about that a moment ago, you could get killed on taxes. If you're paying 25% in taxes to get that money out so you can save yourself 4% interest, probably not good math. The other thing I think about when it comes to paying something off early is this your forever home?
Yep.
Houses typically will appreciate as long as you take good care of it. So is there a need to rush to pay it off? If you're planning to sell it and move it, I would say it may not make sense to go ahead and pay off the house. But if you're going to have kind of a constrained budget in retirement and you have the capacity to pay it off with your cash money that you're making month to month, then it may make sense to go ahead and pay it off to lower your income need for retirement. Those are two very different situations.
Yeah. So what you're saying is it depends on where you're going to take the money from to do it, right? If it's cash savings, go for it. If it's from taxable retirement accounts, you may need to really analyze that to make sure you don't pay too much in taxes and pull assets out of your retirement that you may need for income later. I like to say that when we have a plan put in place with somebody in this similar situation, if we know your retirement date is 65, let's say, because you said you have 10 years left on your mortgage, we might be able to do something that you're not asking, not necessarily pay it off immediately now, not necessarily carry it off for 10 years, but begin to accelerate the mortgage payments because you have some added cash flow potentially and get it paid off by your retirement date of age 65. And that would be optimum for me.
I had a client a few years ago that really wanted to pay off their house, but it would require them to liquidate quite a bit of, and these were after-tax assets, but they would have had to capture some gains. So what we did was we structured a plan where the dividends that they were going to get taxed on anyway from these investments would be routed directly to their mortgage company. So it allowed them to accelerate it without paying it off in a big lump sum and taking that out of their portfolio. And at the end of the day, they still had their investments when it was all done. Another thing to think about, we've talked about Medicare premiums and how those are impacted by your income, but I want to be clear about something I haven't mentioned related to that. It looks back 2 years. So if you're walking into retirement and you make that lump sum right before you retire, it could overinflate your income and cost you on Medicare premiums in a couple of years. So I just want to make sure you understand the impact before you make the decision. And there are ways to, try to get that excluded. There's forms you can fill out, but make sure you're cautious of big lump sums of income right before you retire.
Yeah, there's a lot to consider there. When I think about really where all the questions have gone today, we often come back to there are variables that were not given when we get the question, right? Because they are theoretically or they're more generalized thoughts of, I want to accomplish this. Should I do this? Well, we need to know a few things before we can answer that. So it kind of goes back for me to the idea of everyone's situation is different. We don't know what anyone's complete situation is with the questions we get. So we give you things to think about, and there's probably a lot of people out there thinking about, am I going to pay off a mortgage? What you need to do is create the plan first. Come in, talk to a GenWealth financial advisor, and create the plan for retirement income to see where it makes sense to do something like paying off a mortgage early. There is the final bell. Time for final thoughts.
I was going to say, my final thought is, instead of seeing all the different aspects of your life as separated, think about them collectively and make sure that your plan is looking out for all of them so that when you walk into retirement, you can have some peace of mind about the fact that you have already dealt with or are in the process of dealing with all of those areas and that there's a plan for each thing.
I told a client the other day that I think taxes may be the biggest retirement blind spot there is. But there are plenty. And I think my final thought is, think about how many things we've talked about that could potentially be a retirement blind spot for you. And I would say, is your advisor, if you have one, talking to you about that holistic approach, that plan that includes tax planning, retirement income planning, when to take Social Security, how to work your income so you make sure you're not subject to what is in essence a Medicare surtax. We call it IRMA, and I don't even know what that thing stands for. It's an acronym, IRMMA, but it basically means you're going to pay more if you earn more, right? So you want to avoid that. All of these things need to come into play when you're building your retirement because there are no do-overs. You're not going to get to do this again. So find a financial advisor that has that holistic approach. We've got it here at GenWealth. If you'd like to step in to the GenWealth Ready to Retire process, we've already talked about it on the show, but I'm going to close with telling you how easy it is to get started. Just call 866-653-PLAN. That's 866-653-7526, or send us an email. Send it to info@getreadyforthefuture. That's FOR, forthefuture.com, and get started on your plan for true financial independence. And that's all the time we have for this week's Get Ready for the Future show. Thanks for being with us. If you want to send in a question, please don't hesitate to do it. Write down this number, 501-381-5228. Send us a voicemail or a text, and we'll use your question on the air next time. See you then.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.